Hey everyone, how's it going? Welcome back to Dividend Compounders with Cheese. Right now, my most favorite stocks are overvalued, like Apple and Microsoft. So I'm currently researching for undervalued companies. And so today we are going to talk about Discover, ticker symbol DFS. In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or disgusting dividend stock. When it comes to online banking finance stocks, JP Morgan Chase and American Express get all of the attention. But in my personal opinion, I think DFS is undervalued and it's not on the radar of most people. And if you look at the chart right now, it is trading near its 52-week low. High price was $122.50. The 52-week low was $79. We are only $6 above that right now. What made me interested in researching Discover Financial Services is because of their customer service. I usually dread having to talk to customer service because they just put you on hold and you go nowhere sometimes, right? But when it comes to Discover, I always walk away feeling better. Above and beyond some of the best customer service I've ever experienced. So I decided to look into their financials to see if it's a good company. It's absolutely a weird investing thesis as to why we're doing this. Now, Discover has a game plan on being a one-stop shop for finance-related needs for the consumer. They cover online banking, credit cards, and loans. And let's not forget, this is a channel that is focused on dividend compounding. So let's go ahead and see if they are a dividend compounder with cheese. In 2013, their annual dividend was 60 cents. And over the years, consistently, they have been raising their dividend without fail. And as of last year, they paid out $2.30 per share. All right, so far so good. Let's go ahead and look at their dividend profile to see if everything else checks out. Their payout ratio is currently sitting at 20%. That is beyond healthy. Their dividend growth rate is 17% year over year. Their dividend yield is 3.27%. Now, mind you, the current trading price is $85. It does not get any better for a company's dividend profile to look like this. Amazing. So very recently, Discover reported their Q3 earnings and they missed their EPS by 18% because of higher operating expenses, which at the end of the day is not a red flag because if they increase their headcount, that means they're probably going to have even better customer service. And they had to increase their marketing overhead costs to compensate for their digital banking features. So although Discover missed their EPS expectations, they beat their revenue expectations. And the revenue is important to me. The analysts predicted $3.95 billion, but they posted $4.04 billion in revenue. These are the updated callouts from the previous earnings report and then now. Not much change, except they do expect the loan growth to now be in the mid-teens, so bullish. The next thing we are going to look at is the shares outstanding. We want to find out if the company is issuing more stocks and diluting the shareholders, or are they buying back shares? So in the case of Discover, they actually bought back $1.9 billion worth of shares in the first half of 2023. Right after the Great Recession, it looks like Discover had about 550 million shares outstanding. And ever since then, it looks like Discover has been consistently buying back shares at a very healthy, positive, and aggressive rate. As of right now, they have 250 million shares. So it does look like they bought back 300 million shares since the Great Recession. This is a good thing to see. Next, we are going to take a deeper look at the technical indicators to see what the stock price movement has to tell us. And as of recently, it did reach a 31.98 RSI, which tells us that the stock has been oversold. But since then, it looks like it has been going on a healthy rebound and it is going towards this middle Bollinger Band. The good news is that Discover has a steady line of support every single time that it does reach the lower Bollinger Band, and it rebounds and hits the line of resistance almost every single time. So the key takeaway here is in August, it was definitely oversold when it reached a 21 RSI. However, as of November, Discover has reached a healthy RSI and it is now trading at around 50 RSI. All right, my most favorite part of the video. We're going to run some valuation models to determine the intrinsic value, and then we're going to compare that to what the Wall Street analysts think the price target should be. So the first one is going to be the multiples valuation. So essentially, we are looking at similar companies in the same industry as Discover to to derive a market value intrinsic price for Discover. The companies that I am comparing Discover to are Capital One, Synchrony Finance, American Express, Ally Financial, JP Morgan Chase, which yields a median PE ratio of 8. This is absolutely crazy, but that is the finance industry as a whole. After the Great Recession, the PE ratios have been very conservative. This gives us an intrinsic value of $108.62 for Discover. The next one we are going to do is the discounted cash flow analysis model. Basically, we are going to look at the year-over-year free cash flow growth to determine an intrinsic value for Discover. So it looks like the average growth rate for their free cash flow has been 7.18%. However, if you know anything about me, I am going to use a conservative and safe number, so I'm going to divide that by 2 and use 3.5% instead. And we are going to plug that in alongside with some balance sheet numbers, which gives us a discounted cash flow price of Discover $468 per share. The next one we are going to do is the dividend discount model. Essentially, this model determines an intrinsic price based on the future dividend growth. So in 2019, Discover paid 40 cents every quarter. So every 3 months, you got 40 cents. Fast forward to today, you get 70 cents every 3 months. The average dividend growth rate is sitting at about 15%. But of course, I am going to be conservative and we are going to use safe numbers. So instead of using this 15%, I am going to plug in 7% to the formula. With that, the DDM intrinsic value for Discover is $299.60. The next one is essentially the bear model. Benny Graham's valuation model is going to give us an intrinsic value for Discover based on its growth rate projection alongside with the current AAA corporate bonds yield rate. This number is always going to be low, so I just go ahead and call it the bear model. The Graham value for Discover is going to be $156.20. So this takes us to the conclusion. Is Discover going to be a delicious or a disgusting dividend? The intrinsic value, drumroll please, Discover is worth $258.10. The current trading price is sitting at $85 plus or minus $1 or $2. So what do the Wall Street analysts say about Discover? Well, they say that the price target is $105.82, which is a 23% upside to its current trading price. The low forecast is $93. The high forecast is $135. So even the most bear analyst thinks that Discover is undervalued. We say $258, Wall Street says $105. This is kind of funny because its current trading price is $85. So let's go ahead and see when is the appropriate time to jump in if you are interested in Discover. With a 10% margin of safety, the acceptable buy price is going to be $232.29. With a 20% margin of safety, then the acceptable buy price is going to be $206.48. Wall Street says 105, we got 258. Maybe we are being a little optimistic, even though I use very conservative and safe numbers. So let's go ahead and see what happens when we delete the discounted cash flow valuation from the equation and the DDM value. Okay, so now Discover is worth $132.41 using the very bearish Graham's valuation and the multiples valuation. That means with a 20% margin of safety from this number, the acceptable buy price is going to be $105.93. So hold on. Let's see, what is the margin of safety you get if you are to buy Discover at its current trading price? Okay, so at its current trading price, there is a 35% margin of safety from this intrinsic value. So what do I think? I think that Discover is a absolutely delicious dividend determination. I know that they just went through a scandal back in August where they've been overcharging their merchants, and they are going to take care of that and they are going to pay it back. Do I see Discover going anywhere? No. However, do I see Discover getting more market share? Absolutely. I personally do not think the younger generation is going to go to a brick and mortar bank and open up an account with one of the older big banks. I think they are going to gravitate towards online banks. And I think because of Discover's reputation as having excellent customer service, I think the younger generation is going to appreciate that. Now, with that said, don't just think of this as buying a stock and hoping that it goes up. My mentality is the belief that I am buying into a company. And in this case, an example, Discover. Discover has real operations with a real service and products, and I'm becoming a part owner of it. And I'm trusting the middle management management and the executive team to run the company on my behalf. So my game plan, after seeing the data and running the numbers, I will probably dollar cost average here and there just a little bit every single time Discover reaches the lower 80s. Because I truly do believe that it's better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. And in this case, an example, we can clearly see that Discover is absolutely undervalued. And I'm not really buying into the whole fear and doom sentiment that's going around the market. I think we're going to be okay. People are going to continue to use their credit cards and they're going to pay back their loans and things are going to be okay. Anyways, that concludes this video. If you like Discover after seeing what you saw today, please do your own due diligence and research to determine if you actually like it or not. Now, with that said, this has been another video with Dividend Compounders with Cheese. I'm signing out, stay safe, and I'll talk to you next time.